In this video, I'm going to analyze the PayPal stock and how the company is doing based on its accounts. So at the moment, the PayPal stock goes by this symbol PYPL, and the current stock price is $266 as of April 25th, 2021. So I've shared the link to this Google Sheet in the description of this video. So you can easily copy this and you can use this as a template to analyze any other company. So let's look at the balance sheet. And I'm going to look at the 10K results for the last 8 years. So starting 2012 to 2020, the revenue has grown from $5 billion annually to almost $21 billion end of December 2020. So that is 18% CAGR growth for this revenue to go from $5 billion to $21 billion. So that is pretty massive. And then the earnings before interest, taxes, depreciation, and amortization, it has also grown from 1 billion to 4 billion, which is around 17% as well. So the top line has grown. This is the top line, the sales, the revenue. And then the earnings has also grown, which is the income. The revenue growth, this is the percentage growth of column C. We see that the revenue growth is consistently above 15%. And in 2020, so this is this percentage growth every year in column C is in column E. So almost 15 to 20% revenue growth, meaning they are growing top of line growth is happening. That is pretty good indicator. And we saw that the average CAGR is actually 18%, and yearly is also growing quite well. Ebitda percentage growth is also quite good, 17%, except this 2018 year, it's quite good consistently. They never took debt for almost like until 2018, and then last 2 years they took some debt, the long-term debt. They have lots of cash, way excess of their total debt. So that is pretty good, right? Their total cash on their balance sheet is way higher than their total debt. So not even like the current debt and long-term debt, total debt, the cash, which is current asset that they have, is way higher. So quite good in that sense. The market cap has also gone up from, so this is in billions of dollars. This is millions of dollars. So it's gone up like 42 billion dollars to now almost $277 billion. And this is again looking at December. Now the enterprise value, this is an interesting one, and if you click through you'll see the note enterprise value is market cap plus debt minus excess cash. So if we add up these two, market cap plus debt minus excess cash, you get the enterprise value. Think about this as like if you were to sell this company today, what would you get? So you would get the market cap, which is what everyone's willing to pay, minus the cash, and then plus the debt. So that's also in line. The enterprise value has been like $273 billion. Enterprise value about divided by EBITDA. This is a good metric. The reason why we calculated enterprise value is to find out like what is the multiple that the market is giving to this company. So if we look at this enterprise value divided by EBITDA, which is here, column D. So if we see this, we can see what is that multiple that they are giving. So for a $2 billion EBITDA, they are giving it an enterprise value of $40 billion. So it's like 20 times multiple. So this multiple is going to be very interesting and to keep in mind. So the average is like 30 times. The market is valuing the Ebitda times 30, and it has gone up like 19, 28, 30, 34, and most recently 60 times Ebitda. So this is an important measure to find out like what is the multiple this company is demanding from the public. So this will be good in the future sections where we will cover like what multiple is the market expecting, um, what does the crowd think, uh, what does everyone who owns this stock think about this company and the multiple. So that's a good one. Net debt is almost zero, right? Because as I said, if you from the cash, if you remove debt, it's still positive, so it's close to zero debt company. So we looked at the balance sheet. We created two important numbers: value and then enterprise value about EBITDA. So these two are interesting to take out of a balance sheet. Once we do that, we now look at from the company standpoint, the two key metrics that they share in their 10K is active accounts. How many active customers they have. This also includes their merchants. And so that has grown at a very good rate, almost 20%, from 179 million to 377 million. And the total payments volume has also grown north of 25% consistently, almost from $281 billion going through their ecosystem to almost $936 billion, so close to $1 trillion. So the way PayPal makes money is that it's a brokerage in some sense. The money that goes through their system, they charge a very small penny or very small fee for the transactions that goes through their digital wallets, their merchant ecosystem, the payments. So these are the two key metrics, and they look quite healthy, and it looks like it's accelerating now. The first time ever where the payments volume has gone up 30%, and even the number of users have gone up more than 20% first time. So the acceleration seems quite huge, and so that is quite interesting. And now let's look at their cash flow. So that is going to be very important. From 2014 to 2020, in this we've taken fewer years because of lesser data available. Cash flow from operations. This is interesting because is the business standalone making money? So it is consistently positive, $2 billion to now close to 6, so 3x in the last 6 years. That's pretty amazing. The capital expenditure, which basically says, for me to run my operations, how much money do I need? This is your property, plant, equipment, and things that you need, your servers, your machineries. It's quite low. And so the debt payment also until 2018 was low. In 19 and onwards, there is some amount of debt payment. So the total free cash flow, which is if you add up the cash flow from operations, capital expense, debt payment, you see that this free cash flow is quite good. So this is another thing to take away from this, which is how is the free cash flow? Is this a cash generating machine? And it looks like yes, and it's actually accelerating in a pretty big way. And from the cash flow statement, to quickly recap, there are three parts: cash flow from operations, cash flow from financing, and cash flow from investing. And the free cash flow is a good measure to look at. And if you then look at number of shares that are outstanding, which you can find in the income statement, you can get free cash flow upon divided by the number of shares. So it gives you for the money that this company makes, what does every share earn? So it's like at least $1 in 2014. Now it's $8 for every dollar that's made. Every share commands $8. So from this, what is important is the FCF yield. And what is the FCF yield? Basically, if you look at the current share price, which is this is the share price at the end of the year, which is this share price $36.2 is 31st December 2015, and likewise. So if we did this, and if we know what is the free cash flow per share, and if we know the share price, then we know what is the yield. Meaning every share, if I own one share of PayPal, in 2015 I would have gotten 2%, 2015 5%, and likewise. So my free cash flow per share divided by the share price tells you what is the yield. What percentage money are you making for every share that you own, every dollar that you own, not share. So this is per share and this is per dollar. So this is an important metric to keep in mind, the 3.98% average free cash flow yield. So this will be helpful in our calculation. So let's ignore the ROIC for now, which I'm still working on. But this is interesting, free cash flow yield. So to quickly recap, I think the key takeaway from this is, from the balance sheet, if we can get the enterprise value divided by an EBITDA, we get this enterprise multiple, which is what is the intelligence of the market, stock market, telling that, hey, this company demands this much. And then what is the yield for every dollar that you put in? If you can get those two numbers out of these accounts, then that can help you to analyze, is this a good investment or not? And so let's look at how you do that. Now we're gonna do some forecasting. Forecasting, we're gonna say, hey, for the next 10 years, from 2020 to 2029, how is my EBITDA gonna grow? So we know the latest EBITDA is 4478, so $4 billion. And the latest EBITDA growth percentage, we started at 23%. And where do we get this from? We get this from the balance sheet table, which is here. So if we took this 4478 from here, and then EBITDA growth of 23%, and I'm discounting this one. So if you discount this one, and then if you do the average, you get around 20%. So I'm assuming 23%. And the beauty of this sheet is that you can change this percentage to anything you want that you think is meaningful and get your own price. So starting with EBITDA of 4478 and 23%, and my thesis, so for any forecasting, the number one thing is, this is art. And so the art here is that you have to have some thesis, like, hey, is this company going to grow? And only then can you have earnings income growth of this high percentages. So my thesis is that there is lots of new things that they're doing with Bitcoin. You can actually purchase. Their growth in digital wallet is increasing with Venmo and others. And their growth in active users, as we saw, is massive. The transaction volume is huge. And so I think that the digital wallet is going to replace cash transactions and replace the physical wallet. So this is the thesis. So if this is the thesis, then you can, based on how strong your thesis is, you can come up with these multiples or these percentages. So, but you have a starting point. The starting point is $4 billion and 23%. And for me, I'm gradually decaying it from 23% to 10% over the next 10 years. And so if I put this in, I can easily calculate these guys, because 23% growth on $4.4 billion is $5.5 billion. So once you put your numbers here, you will get these numbers calculated for you. And now, once you do that, you will get like $20 billion EBITDA in 2029. So in 10 years, we are saying PayPal will be at $20 billion. So then you have to do your gut check, like, hey, does this make sense? If not, you should probably change some of these numbers. So now assume you get these numbers. Now you have to put in the second piece, which is the EBITDA multiple. Where do you get that? Remember, we just got that from here. So the average EBITDA multiple that the market is giving is 32 to this company. But let's say I don't take 32, I'm going to just say 20. And once you have 20 times EBITDA multiple, you can multiply 20 times 20 billion and you can get to their enterprise value on 2029 to $416 billion. And then let's say you remove their debt and some cash, which is the current numbers that we have from here, debt and cash. Then we can easily get the market cap. So it will be like $415 billion, and assume the diluted shares remain the same, 101,174, which we saw earlier as well, right? You get that from the income statement, but the diluted shares are also available here. So let's assume that the diluted shares remain the same. In this case, it's 1187. So I'm just going to change this to 1187. So again, all of this can be changed. So this can be changed. All of these can be changed. Once you change these numbers, you get a price target, meaning, hey, this company will be at $350 by 2029. So the current price is $266, and with this Ebitda multiple technique, which is one of the two techniques we're going to learn, we get the future price of $350. So you saw how through balance sheet we got the Ebitda multiple, and we use that to come up with our own Ebitda multiple, our own growth pattern, and we get a share price. If I use the current Ebitda multiple, my share price is going to be much higher, 561, right? So let's go conservative, 20 Ebitda multiple. So this is one way in which you can get the 2029 share price 10 years from now. You can forecast. Interesting, isn't it? Now we're going to look at the second way. The second way is using the cash flow. So we looked at two tables, balance sheet and cash flow. And then the most important part from the cash flow was this free cash flow per share, right? So this $3 that we got is what we're going to use. So where do I get the free cash flow per share? I got it from here. So if you look at the average of this, you get it as $3, right? You see here, average is $3. So that's where I got the free cash flow per share average. But even if you discount these two extremities, even if you just take average of these, you get like $3 to $4, right? So if I take this number of $4 from the cash flow, I can actually have this. The second technique is to look at this free cash flow per share. And once you enter this, that you're going to expect 3%, and you keep the same Ebitda growth from the above table here, right? This is the same table here, and you copy that over here. And once you start with, like, let's say free cash flow per share of $3, then it will automatically calculate like what will be the free cash flow per share at these Ebitda multiples, at these growth rates above, and it'll get you the ending free cash flow per share. And once you get $15, you can use the yield, which is also something that we calculated. Like, what is the yield? The yield is here. Free cash flow yield is an average like 4%, but let's say we'll only get 3% yield. So we get this 3% yield, which is this number here. So 15 divided by 3% gets you a price target of 500. So using cash flow, you get the yield of 3% from the cash flow statement, and you can also project the free cash flow per share. You get $500. You can also change this to say, hey, I don't expect it to yield 3%. I think it'll be yielding 4%, and that the free cash flow per share will start at $8. Then it changes things, right? So you see how drastically it changes things. So I've been very conservative in these. So I've just said, hey, I'm going to just use the free cash flow per share of $3 when we know the latest one is $8, but I just took the average. So that is conservative, I think, $3. So this is conservative, and the yield is also conservative of from the history. So then I get this second way of 2029, which is through cash flow statement. I get a price target of $500. So there are two ways, right? We saw through EBITDA multiple, and we saw earnings multiple, and then the second one was cash flow. So if with cash flow we get a price target of 500. So which one's better? See, is the share price actually going to be 350 or is going to be 500? This is very different, right? So let's give them, let's take 50-50 of each. So if we give 50-50 percentage of the first technique and then the second technique, we get like an average price of 425, which is even more conservative, right? So it's going to be somewhere in between is what it looks like. So now we got this 425 as the midpoint, where we think that the share price, if this revenue continues to grow at this rate that we have shared here, then it will continue to get better and the share price will get higher and higher. So if now we were to buy this share and we get this $425 at the end of it, what is our intrinsic rate of return? Like what are you going to get out of all of this investment? That's something we should calculate next. So if you want to calculate intrinsic rate of return, we just copy the table above that was just up there. And we can say, hey, I'm going to invest $266, which is the current market price. You can change this too. And my free cash flow today would be 266 minus 3, right? So 3 minus 266, meaning I have given $263 because I've paid $266 for the share, but my, the company is earning $3 for every share, so I get $3 back. So my total cash flow for buying one share today would be, at this price, would be $263, right? And my future cash flows would be $4, so I have to keep adding $5 in this year, $6. And if I add all of this up, and then eventually, let's say the share price becomes $425, right, which is what we got from here, then I will get that $425 because I can sell it on 2029 at $425. So my cash flow would be $425 plus 15. So if I look at my total cash flow, it comes up to be here, right? So the total cash distributed would be all of this cash. My stock gain would be the difference between these two, and my total gain would be that much. So basically, I've almost doubled my money, right? By investing at 266, and I get like 425, close to double. So my IRR, intrinsic rate of return, is 8%. So there's a formula that it automatically calculates based on your cash flows, these cash flow streams that you're going to get, what is the intrinsic rate of return? So it is 8%. So at this price, you're going to make 8%, right, with your current assumptions. So on an average, if you were to buy the index in the United States, you can make 8%. So this is not that good, right? Like you can just buy an index. Why do you have to have all of this risk in one stock, right? You can just buy the index and you can easily make 8% over a long period of time. But let's say the stock price were to fall down to 200 rupees, right, at some point. Then my IRR becomes 12%. And if it becomes $150, then my IRR is 16%. But if it becomes 337, which is the highest that it has gone, I think a month back, then if I invest in this, I expect to get 5%, right? Similar to how we did this, it automatically calculates these cash flows. So you can change some of these as well. So if you change this, you get a different number. So if I were to change this to $100, my IRR would be 22, right? So all of these could be changeable. And based on this, we can easily now have a way to say, hey, if I were to buy at today's stock price, I can expect 8%. But if the stock went down by 200 to $200, then I would be 12%, and vice versa. And if I were to buy at 337, which is the peak, then I can expect 5%. So now with this, we are able to change a lot of this and play around with these yellow items. All of the yellow items can be changed. And once you change those yellow items, you can actually see how your assumptions pan out. So let's play around with this. So if you were to play around with this and say, hey, this thing looks like it's going to continue. I expect this company to be a $30 billion company. So then you'd probably do things like, hey, I think it'll be 20%, 20%, 25%, 25%, or 28%, or something like that, right? If I did that, and if I said, hey, this multiple is going to be 30, which is what it is today, then all of a sudden my share price becomes 681. And then if I say, hey, my this thing's going to be $8, then my share price becomes 1266. And at that point, my target price is 974. And at that time, my current, if I were to buy that today, I can still expect IRR of 17%. And so that is massive. So if it were to correct, if the stock were to correct, then I think buying it at a lower price will get you like 26%, which is like massive, right? Even at the peak, it's like 14%. So you see how this is powerful to, based on your assumptions, based on how you think the revenue is continuing to grow, you can even do this now at a quarterly basis and then use this to break it down by quarter and then see how your assumptions change, how the revenue changes, how your cash flow changes, and how based on these two techniques the stock price is changing, because at some point the market gives the multiple. So remember this. So that was very helpful for us to quickly go over like what are some ways in which we can play around with this sheet. I've also given some links here. So I got most of this data from these websites that are pretty cool, like Macro Trends, and you can see all of these data is available here. For the balance sheet data that I showed you, it was the cash on hand. Remember this 1308 is all here, and so you can easily look at let's look at the cash on hand right here. Yeah, so cash on hand $13 billion, so it is here. Yeah, so we get this from here. Pretty much most of this data I got from Macro Trends. From the income statement you can get the diluted shares, which is here, shares outstanding. So that gives you like, hey, how are the shares? The revenue numbers are here. So pretty much you can get everything from here, and it has much more. It even like does stock price history, revenue, profit generation, and many other links are in many other things are in that website. The other one, the most reliable, is the SEC website, where you can actually go and get most of this data directly from the 10K. I got the accounts, active accounts, from here, right? So you get the total active accounts from here. But there are other websites as well, like Statistica, which easily even gives you even better way of looking at like how is their total accounts changing. So easily you can get all of these numbers from there, historical numbers. And the other part that is interesting is the management discussion. So look at this one to really understand like competition and others that can change things. So reading some of these sections would be quite helpful. Specifically the section here around management discussion and analysis of financial conditions. So that gives you a really good overview of like what the company does, how it makes money, and what does the management think about how the company is doing. So really good website, the SEC, the 10K, directly go to their latest results. So hope that was useful. I have shared this link to this doc. You can easily clone this document first, and then you'll have your own copy, and then you can change it. You can play around with it. You can easily see the formulas, and you can see how these assumptions play out for you, and you can do the same analysis for your other companies, and tell me which company you're excited about. I would be interested to know in the comments below. And let's share through your comments what works really well in this analysis. What would you like to see next? And let's use comments for active discussion. Thanks.